Small banks will have a greater uphill task in adapting to the capping interest rates regime. Now, large banks will be the greatest beneficiaries of the new law, even as borrowers face a possible increase in the number of transactions that they will need to undertake as banks try to raise their non-interest income. These are some of the outcomes of a research released by Britam Asset Managers, which is looking into the implications of the new law that allows for capping of interest rates.
The capping of interest rates as prescribed by the new law has its raft of implications.
We certainly feel that it is the larger banks who have more to gain from the amendment to the Banking Act. If you do look at the smaller banks, they have to pay more for deposits, so their cost of funding is certainly higher. You may start to see larger banks buying smaller banks, or smaller banks merging with each other to become a large bank.
According to a research by Britam Asset Managers on the impact of the Banking Amendment Act of 2015, there is expected to be a shift in bank operations as well as a call for government action, with these two possibly pulling against each other.
We're expecting banks immediately to shift towards investing in government securities, that is a risk-free lending.
That thing that we believe should enhance this implementation is the reduction of government borrowing. Overall, we are saying that government appetite should be more towards fiscal consolidation.
The lenders will ideally register lower returns from their main income earner, which is net interest income, and this may push them to create new revenue channels or boost other existing ones.
Banks will seek to drive the number of transactions that are carried out by customers in a drive to grow transactional income.
When one borrower comes and they want a 3-year loan, the cap is at 14%. Another borrower comes and they want a 10-year loan, it's still at 14%. So there's more incentive to give to the short-term credit facilities than to the long-term credit facilities.
The institutions will, however, have to reduce costs, and this is likely to see branches being shut down and thereby possible job cuts loom. Some of the benefits to be enjoyed include growth of non-bank sectors and bank investment.
We believe that insurance will be one of the line items that they are going to introduce in their P&L numbers, and so insurance penetration may actually increase.
The failure of the Central Bank of Kenya to give clarity on some issues came to the fore when the analysts said that further direction needs to be given on issues such as if SACCO and microfinance institution loans are included in the rate caps.